Italy's bond market is being kept calm on the surface, but underneath, the plumbing is already starting to fail. And if you're only watching the headlines, you're going to miss the part that actually moves price. Because the real conflict right now isn't Italy has a lot of debt. Everybody knows that. The conflict is that the system is trying to pretend the risk has been neutralized while the math is quietly getting worse. And the moment the market stops believing the backstop story, you don't get a polite repricing. You get a gap. And later in this video, I'm going to give you the exact checklist for what to watch over the next week or two. The levels, the spread behavior, and the trigger points, so you can tell the difference between noise and a real structural break. Because if one level breaks, the math changes. Here's the uncomfortable starting point. Italy's public debt isn't a scary headline number anymore. It's a living, breathing rollover machine that now sits above 3 trillion euros. And the market is trading that reality like it's a footnote. That disconnect is your first signal. Italy's debt was reported around $3, $13 trillion in the most recent official updates. And that's not a philosophical issue. It's a funding issue. It means the state is a permanent borrower. It means auctions and syndications aren't events. They're oxygen. And it means the only thing that matters is the marginal buyer. Who shows up, why they show up, and what makes them stop showing up. Because that's where the real pressure starts. Now look at what the market is telling you on the surface. The 10-year BTP yield is sitting in the mid-3s, and the spread to Germany, this is the part people treat like a heartbeat monitor, is hovering around the mid-60s basis points, flirting with the low end of its recent range. That's the market whispering, we're fine. That's the market implying Italy is basically Germany with better pasta. And that is precisely the kind of message you get right before the stress shows up. Because spreads don't deteriorate like a slow-motion documentary. They stay calm until liquidity thins, positioning gets crowded, and then they jump. And the next detail is what flips the whole setup. Because the spread being tight does not mean the risk is gone. It can mean the risk has been warehoused. It can mean the trade has become consensus. It can mean carry is so popular that people are forced to keep buying just to avoid underperforming. Tight spreads can be a symptom of confidence, yes, but they can also be a symptom of suppression by structure, by central bank footprints that haven't fully faded from the system, by risk parity style demand for yieldy duration, by banks holding sovereign paper as collateral-friendly ballast, and by funds chasing a simple idea, pick up extra yield, hedge a little, clip the carry, repeat. That works until it doesn't. And when it doesn't, it unwinds in a straight line. So let's talk about the so-called death spiral. Without the cartoonish drama. A sovereign death spiral isn't a single crash day where the screen turns red and everyone screams. It's a sequence. Step 1, yields rise. Step 2, interest costs rise over time as more of the debt rolls and reprices. Step 3, the government issues more to fund the deficit and refinance maturities, adding supply right when demand is getting more price sensitive. Step 4, the market demands more term premium because volatility is back and political risk is no longer theoretical. Step 5, higher yields feed back into banks and domestic balance sheets through mark-to-market, collateral haircuts, and funding stress. Step 6, banks and funds de-risk, selling the same bonds that are under pressure, which pushes yields higher again. It's not magic, it's reflexivity, and it doesn't need a villain. Incentives are enough. Here's a simple piece of math that people avoid because it's too blunt. On a stock of debt above $3 trillion, a 100 basis point shift in the average funding cost is not a rounding error. In the long run, once the debt stock is rolled at higher rates, that's on the order of tens of billions of euros a year in extra interest burden. Not immediately on day one, because maturities are staggered and the average maturity buys time, but the direction is relentless. Every auction matters more, every basis point matters more, and the margin for policy mistakes shrinks. And that's why the market's calm tone is the tell. Because the market is pricing a world where nothing forces a repricing. That's the bet, but that's not the part that matters. The part that matters is that the backstop has changed. The European Central Bank is not the same buyer it was during the era when every wobble in periphery debt could be met with some version of, don't worry, the central bank is recycling maturities and maintaining a supportive footprint. Pandemic-era support mechanisms mattered because they changed the psychology of the marginal buyer. They made it feel like duration risk had a guardian. But now, reinvestments under the fiat program were discontinued at the end of 2024. That's a regime change. It doesn't mean the ECB can't act under stress. It means the default flow is no longer quietly absorbing paper in the background. It means the market has to digest more of what is issued. More honestly, more often. And when digestion becomes the story, spreads stop being a trivia stat and start being a stress gauge. Because if this one level breaks, the math changes. Now, I can already hear the skeptical voice. But look, Italy is issuing just fine. Demand is strong, auctions clear. There's always a bid. Yes, and that's exactly why this setup is dangerous. In early year issuance windows, especially right after a calendar reset, there's a stampede effect. Funds have fresh risk budgets. Banks and dealers are hungry to put on carry. Everyone wants to start the year positioned. A big deal gets done, it's oversubscribed, and the narrative becomes, see, no problem. But oversubscription doesn't tell you the market is safe. It tells you the market is crowded. It tells you everyone is leaning the same way, and crowded trades don't break gently. They break when funding conditions tighten, when volatility spikes, when the hedge fails, or when a political headline forces the market to price risk that was previously ignored. And that brings us to the catalyst that's hiding in plain sight, the calendar. Markets don't move on logic alone. They move on constraints. The calendar creates constraints. You get periods where liquidity is thin and positioning is heavy. You get windows where systematic flows rebalance. You get option expiries that shift dealer hedging. You get month-end and quarter-end behavior where funds defend performance, de-risk, or add exposure to match benchmarks. And right now you have a cluster of why now triggers. A fresh issuance season, thin early January liquidity that can exaggerate moves, and a market that is still digesting the reality that the central bank ES passive support has faded. That's the environment where spreads can go from sleepy to violent in days, not months. And then the next detail kicks the door in. Because the moment sovereign stress becomes a live conversation, it stops being a bond nerd story and becomes a collateral story. And collateral stories bleed into everything: currencies, funding markets, bank balance sheets, and most importantly, for you, if you're watching this channel, the hard asset complex. That is when silver stops trading like an industrial metal with a cute inflation narrative and starts trading like a financial pressure valve. Here is the bridge you need to understand when trust in paper claims weakens, even slightly. Money doesn't just buy safety. It buys scarcity. It buys assets that are harder to dilute, harder to conjure, harder to promise into existence. Gold does that in a slow, sovereign way. Silver does it in a chaotic, leveraged way. Silver is the metal that behaves like a commodity on the way up and a margin call on the way down until the physical market tightens, and then it behaves like a trapdoor. And that's where the real pressure starts. Now let's place the silver context on the table right now, today, this week. Silver has not been acting normal. It's printed prices in the high 70s per ounce in early January with violent swings that would have been unthinkable not long ago, including a pop into the low 80s and then a sharp snapback. If your instinct is to say, that's too crazy to be real, that's exactly the point. In a stressed system, you get discontinuous repricing. You get a market that is discovering its own fragility in real time. And if you were wondering how on earth we go from high 70s to a title that says $400 silver, stay with me, because the path is not a straight line and it's not a fairy tale. It's structure, it's positioning, it's availability, it's the hidden detail. And the hidden detail is what flips the whole setup. The hidden detail is this: plenty of silver exists, can be true, while deliverable silver is scarce, is also true. That sounds like wordplay until you understand how modern metals markets actually function. Silver doesn't trade as a single global pile where one price naturally equilibrates everything. Silver trades through nodes, vault systems, delivery rules, logistics, refineries, assay standards, and the simple reality that metal sitting in one place is not instantly usable in another place without time, cost, and friction. When the benchmark pricing venue is undersupplied relative to demand for deliverable bars, the paper market can quote whatever it wants until someone demands delivery, or until spreads and lease rates start screaming that the physical market is tighter than the screen implies. This is where people get lost, so let's make it simple. Futures markets are promises. They are contracts. They are powerful tools for hedging and price discovery, but they rely on an assumption. If you really need the metal, the system can deliver it in the correct form, at the correct location, within the correct window, at a cost consistent with the futures curve. When that assumption wobbles, price discovery becomes disorderly. You don't get a gentle adjustment. You get a veto. The physical market vetoes the paper market by refusing to provide the inventory the paper market assumed was available. And when that happens, everything else follows. Spreads distort, basis moves, volatility explodes, and forced hedging turns a move into a cascade. But that's not the part that matters. The part that matters is what this forces participants to do. Dealers and market makers don't get to have an opinion in the middle of this. They have risk limits, they have margin requirements, they have hedging rules. When volatility spikes, margin goes up. When margin goes up, leveraged holders either post cash or reduce exposure. Reduction means selling. Selling pushes price down. That creates more volatility, which raises margin again. That's the down move. On the up move, it's just as violent, but with a different trigger. Short exposure becomes unmanageable, hedges fail, and forced buying hits a market where liquidity is thinner than it looks. That's how you get vertical candles. That's how you get gaps. And that SY $400 isn't T a meme number in a broken regime. It S the kind of number you see when a market is forced to clear at a price that shuts off demand and pulls metal out of hiding. Now, let's connect the two worlds, Italy's bond math and silver's structure. Italy is not an isolated island. It sits inside a monetary union with political constraints and fiscal negotiation. In calm periods, that's manageable. In stressed periods, that structure creates conflict. Who pays? Who guarantees? Who compromises? Who carries the risk? And when you add geopolitical pressure, call it alliance friction, defense spending demands, or a NATO cohesion narrative, the market starts assigning a premium to uncertainty. Not because traders are reading strategy papers, because risk managers are watching volatility, correlation, and liquidity. Because when security priorities shift, budgets shift. When budgets shift, deficits shift. When deficits shift, issuance shifts. And when issuance shifts into a market without a passive central bank absorber, spreads have to do the work. That's the chain, and that chain is already tightening. So what proof do we have that this is more than dramatic storytelling? Let's stack it quickly like a trader would. Proof point 1, the debt stock is not stabilizing at a comfortable level. It's elevated and still moving. That means the refinancing machine remains large, permanent, and sensitive to rates over time. Proof point 2, the spread is extremely tight relative to the debt reality. A BTP bund spread in the mid-60s is the market saying complacency. Complacency can persist, but it's fragile. Proof point 3, the central bank's passive support through reinvestments has changed regime. Even if emergency tools exist, the baseline flow is less supportive, which means the market must clear more honestly. Proof point 4, the bank's sovereign linkage remains the silent amplifier. Domestic banks holding sovereign paper don't need to blow up to matter. They just need to become more cautious because caution is selling pressure. Proof point 5, silver is already telling you that the system is more fragile than the headlines admit because silver's volatility and price behavior are what you see when the market is wrestling with availability, location, and leverage. And we can add more. Proof point 6, the physical market narrative isn't shortage, it's stuck inventory. Metal in the wrong place relative to benchmark delivery needs. That is exactly the kind of imbalance that creates squeezes and discontinuous repricing. Proof point 7, early year and index-related flow windows can mechanically create selling or buying pressure that has nothing to do with fundamentals, which is why price can whip around violently even if the thesis is correct. And that's where the real pressure starts. Now, the big question, why does any of this point to $400 silver? Here's the honest answer. It doesn't point to $400 next week. It points to a regime where $400 becomes plausible as an endpoint of revaluation if the system keeps pushing paper claims against constrained deliverability and if macro stress accelerates the preference for hard collateral. That's the difference. The title says inevitable because the incentives are aligned. When institutions face sovereign stress, they seek collateral that survives policy improvisation. If silver becomes a collateralized scarcity asset in the public imagination and in institutional risk frameworks, the repricing isn't linear. It's a jump. And the way to understand that jump is through ratios and nominal reset, not straight line prediction. If gold is in a world where major banks are already talking about multi-thousand prices in the years ahead, and if the gold to silver ratio compresses during a genuine hard asset phase because silver is smaller, more volatile, and more reflexive, then silver doesn't need a miracle. It needs a regime shift. A ratio that moves from fearful and tight to a risk on hard assets can change the silver number dramatically. A gold price that rises while the ratio compresses is how you get silver numbers that sound insane until they print. But that's not the part that matters. The part that matters is the path, because the path is what shakes people out. Most people cannot hold through the path. They buy the idea, then they get stopped out by the volatility that is literally the feature of the trade. So let's talk about that volatility as a weapon, because it will be used against you. Here's how the market manipulates retail psychology without needing a conspiracy. First, it gives you a clean breakout that feels obvious. Then it punishes the obviousness with a savage pullback. Headlines appear to justify it. Profit-taking, macro fears, strong dollar, weak demand, pick your poison. Then, when you're emotionally exhausted, it rips higher again, usually on a day when you're busy, distracted, or convinced you missed it. Then it gaps down overnight on thin liquidity because someone deleveraged. Then it recovers in a slow grind that feels like it's going nowhere. The goal is simple. Make you emotionally liquid. Make you trade your position instead of holding your thesis. Make you buy high, sell low, and then blame yourself. The antidote is not courage. The antidote is process. Process means you separate trend signal from noise. Trend signal is structure. Spreads, inventory term structure, policy regime, and positioning. Noise is daily headlines and intraday spikes. Process means you define invalidation, not I feel bad, but feeling. But if this level breaks and stays broken, the thesis is wrong. And process means you accept something that feels unfair. Even if you are right, price can whip around violently. It's allowed to. It's designed to. That's why risk management matters more than conviction. And that's where the real pressure starts. Now let's get specific about mechanisms, because this is where serious viewers separate themselves from hype merchants. On the bond side, the key mechanism is liquidity and marginal demand. Italy issues a lot of debt. The market can digest it when risk appetite is high and volatility is low. But volatility is the tax on leverage. When volatility rises, the carry trade becomes less attractive because the yield pickup no longer compensates you for the price swings, especially if your funding cost rises and your hedge becomes unstable. That's when you see auction tails. That's when you see dealers step back. That's when the spread stops drifting and starts jumping. On the silver side, the mechanism is the physical paper relationship and the derivative reflexivity engine. Futures and options are enormous compared to the physical float that is actually deliverable in the right place, in the right form, on demand. When physical availability tightens at the benchmark node, you can see it in the curve. A tight market can show backwardation, can show stress in nearby spreads, can show elevated lease rates, can show unusual basis behavior. You don't need every number. You need the direction and the persistence. Persistent tightness tells you the market is paying up for immediacy. And paying up for immediacy is the kind of signal that precedes violent moves. Because if immediacy becomes valuable, someone is forced to act now, not later. Then add options. Options turn price into hedging. When a lot of call options pile up at certain strikes, dealers who sold those calls hedge by buying the underlying as it rises and selling as it falls, depending on the gamma profile. In positive gamma conditions, dealers can dampen moves. In negative gamma conditions, they can amplify them. This is why you can get days where silver feels like it is just being pulled by a magnet through round numbers, because hedging flows cluster around strikes. And when the market moves fast enough, hedging becomes chase the tape. That's not emotion, that's math. And that's the setup retail almost never sees in real time. But that's the part that matters. So what is the why now calendar trigger that makes this feel imminent instead of theoretical? It's the compression of flows into a thin liquidity window. Early January is when portfolios rebalance, new money gets allocated, and macro narratives get reset. It's also when many systematic strategies recalibrate after year-end. Add in commodity index rebalancing windows that can mechanically force selling or buying in specific commodities, flows that have nothing to do with fundamentals. And you have the perfect recipe for violent swings that look like randomness, but are actually schedule-driven. Then layer in the political calendar, negotiations, budget headlines, alliance tension, and policy signaling. You don't need a single perfect catalyst. You need a fragile system. And we have one. Now, before we get to the roadmap, I'm going to do something most hype videos refuse to do. Give you the strongest counterpoints, and then tell you exactly what would make this thesis wrong or early. Counterpoint 1, spreads are tight because fundamentals improved and confidence is real. It's possible. A tight spread can reflect genuine belief that Europe won't allow a periphery blowout, that fiscal management is stable enough, and that growth and inflation are not forcing a shock. Counterpoint 2, ratings and institutional views have been stabilizing, so this is overblown. Upgrades or improved outlooks can matter at the margin, because they influence mandates and risk budgets. Counterpoint 3, silver is already up massively. The move is done. That's the classic end of move argument, and it's often right in normal markets. Here's the rebuttal, and it's not emotional. Spreads can be tight right up until the moment liquidity breaks. Ratings are lagging indicators. They reflect what has been, not what will be under stress. And silver, in a structurally tight and reflexive regime, doesn't finish with a gentle top. It finishes with volatility that shakes out believers. If silver were quietly topping, volatility would compress as enthusiasm fades. What we're seeing instead is a violent two-way trade, which is consistent with positioning, location constraints, and forced flows battling each other. That doesn't guarantee higher prices tomorrow. It tells you the regime is unstable, and unstable regimes are where tail outcomes live. So let's talk roadmap. What do you watch next week and the week after if you want signal, not noise? On Italy, stop staring at Italy debt is high. You already know that. Watch the spread behavior. A spread hovering in the mid-60s is calm. What matters is whether it starts to lift and hold, whether 80 basis points becomes the new floor, whether 100 becomes sticky, and whether 150 starts to enter the conversation. The level itself is less important than the character. Does it drift or does it gap? Do rallies and BTPs get sold immediately or do they hold? Do you see days where bunds rally but BTPs fail to follow? That divergence is stress. Watch auction tone and demand quality. Is demand real money, or is it leveraged carry? Watch bank equity behavior relative to sovereign moves. Banks are the transmission belt. On silver, watch the nearby behavior, not the long-term fantasy. Watch whether dips are bought quickly or whether they bleed. Watch whether round number levels behave like magnets. Watch whether the market can hold above key psychological areas after a spike, because holding is different from spiking. If silver printed into the low 80s and then snapped back, that tells you the market is searching for balance. The question is whether it finds balance higher or whether the flush is deeper. Either way, respect that both outcomes can be part of the same bull regime. This is the part retail struggles with. A violent pullback can be bullish if structure remains tight and the move is driven by forced positioning rather than a collapsing fundamental. But you need an invalidation line. You need a level that tells you, if we break and stay below this, the market is not in squeeze mode anymore. That level will depend on your time frame, and I'm not here to tell you what to do with your money. I'm here to tell you what the market is likely to do to your emotions. Now here's the two scenario lens that keeps you sane. Scenario 1 is the controlled pullback and retest. In this scenario, silver bleeds lower in a messy way, shaking out late longs, calming volatility a bit, and then building a base. It's frustrating. It feels like nothing is happening. It's where weak hands leave. Meanwhile, the underlying tightness doesn't disappear, because once a market re-rates into scarcity collateral mode, price is not set by fair value. Price is set by what clears. And clearing prices can be brutal. Now, how does Italy fit into those scenarios? Italy is the macro accelerant. If spreads stay calm, silver can still be volatile on its own structure, but the collateral panic premium stays contained. If spreads start widening and staying wide, if European political cohesion feels shakier, if defense and fiscal narratives collide and create budget stress headlines, then the hard asset bid gets a new reason to exist: trust. That's when metals benefit from more than just industrial demand and inflation expectations. They benefit from a flight to durable collateral. And silver, because it's smaller and more reflexive, can overshoot in a way gold often doesn't. That's the setup. Now, I'm going to say something that will save you money if you actually listen. The market will try to make you feel stupid for being early and stupid for being late. If you buy a breakout and it pulls back, you'll feel stupid. If you wait and it rips, you'll feel stupid. That emotional loop is the trap. The solution is to think like a risk manager, size and time frame. If your horizon is weeks, you watch levels and flows. If your horizon is years, you watch regime and structure. And if your horizon is, I want to be right today, you're going to get farmed by volatility. Because volatility is the toll you pay for being in a trade with real upside asymmetry. So here is the concrete payoff I promised at the start, the next week checklist. If you want to know whether this story is escalating, you watch 3 screens. Screen 1, BTP Bund spread behavior. Calm is mid-60s with orderly drift. Stress is sustained movement higher with jumpy tape. Stress is also divergence, where Germany rallies and Italy doesn't. If you see that, pay attention. Screen 2, Italy's yield level relative to its own recent range. Not the exact number, the direction and speed. Slow is manageable, fast is dangerous. If yields start climbing rapidly, funding narratives get louder and risk managers tighten. Screen 3, silver's ability to hold gains after volatility spikes. If spikes are immediately retraced and followed by deeper breakdowns, the squeeze is pausing. If spikes are partially held and dips are bought aggressively, the market is building a higher platform. And if silver starts making higher lows while volatility remains high, that's often the signature of a tight market being fought over by forced flows. And one more thing, because it matters more than any chart, watch the narrative swing. When mainstream takes a complex structural story and reduces it to speculators did it, that's often the moment the real move is still ahead. Because the mainstream needs a simple villain to explain price, while the actual engine is structure and constraints. Now let's end where we began, with the bond death spiral idea. Italy doesn't need to default to create a crisis of confidence. It just needs the market to demand more compensation for holding the paper. It needs a few ugly auctions. It needs a few political shocks. It needs a bit of bank caution. And it needs the absence of an automatic central bank reinvestment flow to make the market do the clearing on its own. In that world, spreads aren't a statistic. They're a trigger. And in that same world, silver isn't just a metal. It's a pressure gauge on trust, deliverability, and leverage. Its price is telling you that the system is not as stable as it looks. The swing into the low 80s and back is not a joke. It's a warning. It's the market rehearsing a bigger move. And when the rehearsal is that violent, you don't want to be the person who only shows up after the main event starts. One last reminder, because credibility matters. Nothing in markets is guaranteed, and no one gets to skip the volatility. Even if the long thesis is right, price can punch you in the face first. That's not failure. That's the nature of reflexive markets. The goal isn't to predict every tick. The goal is to understand the machine well enough, that you are not emotionally manipulated by the noise, and you recognize when the machine is changing gears. If you're the kind of investor who wants the mechanism, not the meme, if you want to know what to watch before the headline, not after it, then you already know what to do. Stay close, stay evidence-driven, and don't let volatility rent space in your head, because the next detail is what flips the whole setup, and it's already forming.